everyone. In this video, you will be learning recognition of financial instrument, that when to recognize the financial instrument in your books. So in the last video, we have learned about the financial instrument. Just a quick recap. So financial instrument is a contract that give rise to asset for one entity, liability for another entity, and the net settlement is in cash or equity. So whatever satisfy these four conditions will fall under the purview of financial instrument. So that we have studied up till now. Okay. So IFRS 9 talks about financial instrument. What is financial instrument? How to recognize and measure, and also talks about the impairment of financial assets and hedge accounting. So let's see when to recognize a financial instrument. I am a product controller. I'm product controller, and my duty is to ensure that P&L reported by the trading desk is true and fair. So there are thousands of trades in a day. So some are standard trades, vanilla trades like loan issued, and some are structured trade where there are complex trade, you can say, where many components are uh, structured in a single contract. So there is derivative, there is a loan, there is a note in a single instrument. So these are also trade. So the basic thing is, when should we enter these trades in our books of accounts? And I'll need to make sure that the P&L reported is true. What do I mean by true? A trade can be a bogus trade. It just entered into the system by the trader, just like that. And it defeats all the purpose of a product control if I am not sure if the trade is good or not. So I must need to verify that trade. With whom verify? With whom we have entered into the contract. That is counterparty. So I need to verify the trade with the counterparty. But to be very honest, it's not the product controller's duty. It's the duty of operations. So operations verify each and every trade. And we confirm with the ops, like, has the trade been verified? By verified means the counterparty has confirmed the trade. So once the trade is confirmed, then only it can enter into our books of accounts. Until then, it's nothing. It's just a single transaction in our system, and it will not be flown into the ledger. So all the unconfirmed trades are a big risk to the bank, to the desk. So there are chances that can be affected, that they are the bogus trade, and that will generate to fictitious PNL. Okay, so IFRS 9 also says the same thing. So when to recognize a trade? So IFRS 9 requires an entity to recognize a financial asset or financial liability in its statement of financial position. Statement of financial position is nothing but balance sheet. So recognize a financial asset or financial liability in the statement of financial position when it becomes party to the contractual provision of the instrument. So when it becomes party to means when it is confirmed, like when we are obliged, when we got some rights, when we have some liability. So when we become party to the contractual provisions of the instrument, then we can recognize that trade in our books of account. Okay, so once you know about when the trade can be recognized. Okay, So when we are a party to the contract, we can recognize the trade. Okay. Let's see when to derecognize. Which seems to be a very simple question. When to derecognize? So you are recording, you have given a loan, so it's your asset. So when shall we derecognize that? Or you have a bond, that is your asset. When shall you derecognize that bond out of your books? So you are getting, so you have a bond, you are getting coupons on it, and on maturity you get the principal and the last coupon payment. I don't know the spelling. And the last coupon payment. So when you have received everything you are supposed to receive, when you have all the cash that you're supposed to get, yet you have no right to get more cash out of that asset, then you need to de-recognize the bond because it has no value. Why do you show something with a zero value? Because you will not be getting anything. You have invested money, you get the coupon, you get the principal, everything you got it has no value. Just de-recognize it. Or when you make a sale, so when you sold this bond in the market, so you have no right, you have no ownership, you have transferred all the rights and responsibilities. So it's not your asset. De-recognize it. Kindly de-recognize it. So what IFRS 9 says, the asset can be de-recognized if either the contractual rights to the cash flow of the financial asset have been expired. So cash flow of the financial asset have expired, or the asset is transferred, that is sale, and that transfer qualify for de-recognition. So either contractual right of the cash flow expired, so right to the cash flow have been expired, that you have no right to receive future cash flows, or you have transferred the assets with all the risk and rewards. That is very important. You have transferred the asset with all the risk and rewards. So you have given the full control. Why I say it's more important to understand the risk and rewards. And why the both condition must be there, that transfer must be there and risk and reward must be there. So let's suppose you have an asset, you have a bond, you have a bond, and you entered into an agreement that you will transfer that you will transfer all the income, you will transfer all the income to Mr. X. So you will transfer all the income to Mr. X and all the losses as well. You are the owner, but all the returns you have an agreement. You have agreement that you will transfer all the returns to Mr. X. So you will transfer all the return to Mr. X. But you are the owner. Are you getting out anything out of that bond? Is it your asset? Just tell me, is it your asset? No. So if it is not your asset, what the hell is this doing in your books? De-recognize it. So IFRS 9 says you can de-recognize and you should de-recognize that asset on which you don't have any rights. So the desk purchase a bonds and enter into a contract with the client to pay across the total return from that bond. So you have agreed enter into agreement to transfer the total return. This return would include all the contractual cash flow of the bond, that is coupon and principal. Although the bank is still the legal owner of the bond, it could be argued that all the risk and rewards of the ownership have been passed to the client. So, which permits the desk to de-recognize the bond from the balance sheet. This is known as pass-through. So, in pass-through, we should de-recognize, but US GAAP has a different viewpoint. He says you are the legal owner. until you are the legal owner, recognize this as your asset. Recognize this in your balance sheet. So, are you good with me? But another case, when we say to recognize, there are cases when you sold the asset, but you have all the rights for the return. You have all the risk and rewards are not transferred. You have made the sale. So the classic case is repos. So first, what you need to understand, what is repo? First, you need to understand what is repo. Repurchase agreement. What is repurchase agreement? So you are Mr. B. You have a wonderful investment opportunity, but you have liquidity crunch. So you have a wonderful business opportunity and you have liquidity crunch. So what you do is you go to Mr. A. You ask Mr. A, please lend me 50 millions. Mr. A has money, but he is not sure if you'll be able to pay or not. He asked, what do you give me in return? He said, I will give you 500K for 3 days. 500K for 3 days. That's a good amount. But he's still not sure. The amount involved is 50 million. So they ask, so they ask Mr. B to give some more surety, collateral, something like that. So Mr. B says that I have bonds of 51 million. It gives smile to the face of Mr. A. He says, okay, sell it to me and take the money. He says, I don't want to sell it. I want to keep it. This 50 million will become 1 billion. Okay. So he said, okay, we can have an agreement that when you will return my money with interest, you can purchase that bag. So when you pay my money with interest, you can purchase this bag. So there is a repurchase agreement. So there is a repurchase agreement. So there is a repurchase agreement, and first there is a sale. So first the securities are sold and then repurchased when the amount is being paid. So this is called near leg. In the far leg, like when amount is paid, when when amount is paid back, so bonds are purchased back. So how it looks in the balance sheet, let's look at it. So you understand repos now. What is a repo? So you sold goods for a timing. So it is a short-term financing arrangement. What is? It is a short-term financing arrangement. Although there is a sale of securities, but all the rights and reward, all the rights, risk and rewards will sit with you only. Okay. So how does it look in the balance sheet? So you have the bonds of 51 million. It will remain your asset. So IFRS 9 says it will remain your asset. You got cash of 50 million. The cash you have, it's your asset. But you also have a liability of 50.5 million that you need to pay. That liability is a repo. And what Mr. A will show? Mr. A will show there is one asset. He got one asset that is you by the name of reverse repo. So the agreement he has, that is reverse repo. So he will show this asset and will reduce the cash by 50 million. Although there is sale, but the asset will remain in your box. Because this is called repos. So when you go for an interview, there is a pet question: is reverse repo an asset or liability? Just rapid fire kind of question. So reverse repo is your asset. Repos are liability. Okay, let's move further. Okay, let me tell you a history because I told you US GAAP permits to de-recognize the asset when you make a sale. When you make a sale, US GAAP allows you to de-recognize the asset. So you must have heard of Lehman Brothers. They are the masters of window dressing. They what they used to do, they have some bonds, let's say, or other assets of okay, around 50 billion. Yes, this was the scale. In early 2008, they have 50 billions of asset, which they were not showing in their balance sheet. What they will be showing is cash of 48 billion. How they are doing it? They sold this asset, not sold because no one was ready to buy it actually. They might be ready to buy, but let's not go into that. They entered into repo agreement for 50 billions. They get a cash of 48 billion. For 50 billions, they get a cash of. So to show this balance sheet, which have a 50 billions of asset, a bond, which is not of a good quality, gives a concern to the shareholders. Like they have these assets, they might default. They might default. When they go to another financing arrangement, they will see this balance sheet. So they used to do like multi transaction. They sit in US and does the repos with UK. So they may default. That might not look good to anyone. But when they see like the balance sheet has a cash of 48 billion, I tell you, anyone can be impressed by this. They're sitting on it. This is a cash cows, we can say. They have a cash of 48 billion. They can buy anything. They can invest in anything. So that how they window dress it, how they misrepresented their numbers. Actually, they have bonds of this, but they instead of let me show you how they used to do it. So if they have been showed it as uh, repos, they must be shown like that. So one must can understand that they have bonds of 50 billion, which may go bad, which may go bad. They have repos of 48 billion that they have to pay, and that there is a cash. But what they do is they show a wonderful picture with the backup of US gap supporting them. Okay. So this is Repo 105. Why we call it 105? If you see, it's approx 5%. I have used the rounded of figures. So for 100 rupees of loan, they were giving the assets of 105. I tell you, this is a huge number. When there is a short-term financing, they are giving like a 5% more because the assets must not be of very good quality. So this is Repo 105. Okay, and let's see when do we recognize a financial liability. It's very simple. It's very simple. When you don't need to pay anything, when the obligation is discharged, cancelled, or expired, when you don't need to pay anything, yet there is no obligation, so we can say you can recognize the liability. So we are not going into detail. That's sufficient, I believe.